Good afternoon and welcome to today's edition of Unfiltered Finance. I'm fortunate to have Yelena Maleyev on air with me today. I recently heard her speak publicly, had a great conversation before because she got inundated by everybody when she got off the stage to speak to her. And I thought it'd be great for all of you to have her on. She's a young economist, and there are various things that I hear people, people are concerned with, such as the housing market and the labor market, and she knows her stuff, and her opinion is worth listening to. So, Yelena, thank you for coming on Unfiltered Finance today.
Thanks, Ron. It's an honor to be.
Pleasure really is mine. So, my children, as I mentioned to, my twins are turning 30 this Saturday. So last year we had a wedding. Next year we have another wedding between the two of them. And one is starting to look for houses. And I'm hearing this from not only my children, but a lot of my contemporaries' children, that they're just priced out of the housing market. And if you look at Mondani, his platform of affordability really garnered the attention of the 20-something or even 30-something crowd. The median age for first home purchases I looked up was 40 years old as of 2025, and last year it was 38 years old. So I wanted to get your take and thoughts on what you're saying, but one thing that I was sort of surprised by in doing my homework, according to the Wall Street Journal, an article that was updated today, it said that 2/3 of home buyers last year purchased at a discount to the original listing price, which if you live in the Northeast, everywhere, because I recently bought a home last year in June, that doesn't seem to play out. It seems to be the houses are selling really quickly and they're selling for over ask. So this is a big issue in the United States. So I wanted to get some of your thoughts and discuss it.
Yeah, thanks, Ron. I mean, what a great setup as well, because I just want to provide some context to the listeners as well, if they're not following the housing market as closely as you have been, if they're not as invested in the comings and goings of house prices. So essentially, when we economists say the housing market, we're really talking about aggregation of like hundreds and thousands of mini markets, right? Because housing is very local. And what happens in usually one market tends to kind of also show up in others. But over the past few years, especially since the pandemic, everything kind of got broken. Cycles essentially got broken. And so what we're seeing right now, yes, I read that same article as you did, with a lot of buyers getting purchases for below ask. First thing, a lot of those purchases happen in the South, where we have significantly more supply, and I'll talk about supply in a second. And then second of all, asking prices have remained kind of unrealistic in some markets. So when remember when COVID first hit and a lot of folks got really scared about, potential job losses and what have you, that everyone just kind of, pulled back from economic activity. But that didn't last very long because people realized they got to keep their jobs and work from home. And then they realized they got to work from anywhere and keep their big city salaries. So we had this huge migration into parts of the country where you kind of saw this location arbitrage, if you will. So folks with a New York salary could move to Florida, Bay Area salary could move to Idaho. And then over time, the sellers of those markets were like, hey, I can list my home for double what I bought it for 10 years ago or what have you. So that psychological change takes time. Like it's almost like a grief process. We haven't really hit the acceptance stage yet by sellers that you can't list your house for double what you sold it for, what you bought it for 10 years ago, because the housing dynamics have really shifted since the pandemic times. And so yes, we have listings, price cuts significantly up due to sellers, first of all, listing their homes at unrealistic prices in a lot of parts of the country. And then second of all, the types of homes that are being sold. So if you're a vacation home buyer, or this is like your fourth house and you're going to use all cash, you're probably looking at the higher end of the market. There's a lot more supply at that place in that space. So you're going to have a lot more discounts because there's just more supply. But if you're a first time home buyer, like you said, you're age 40 and you've been saving up a lot longer. So you have a bigger maybe down payment, but you still need more of that entry level home, which we just do not have enough of. And then you're going to be in those price wars, in those bidding competitions. You're not going to be seeing a sale below asking as frequently. And you're probably not going to see those homes available in certain parts of the country, like the Northeast, which is notoriously very difficult to build new housing stock in. New York, Manhattan is, at the epicenter of all of that. You just cannot build anything new for housing on the island. So there's a lot of different dynamics happening. Essentially, it really is down to, supply versus demand. We have a huge cohort of millennials in their prime home buying years who have been waiting with bated breath to enter the housing market to finally make those big life decisions like their parents did. At the same time, their parents the baby boomers are aging in place, living longer, wanting to stay at home longer. And so they're holding on to a lot of that housing stock. And then behind the scenes of all that, regulations have changed so much, and the dynamics of, the costs of building a house, that builders aren't really able to build those kind of first time home buyer, those, like 800 square foot townhomes that like a first time home buyer at the age of 25, 50 years ago could have purchased with maybe one income. Now we're looking at, you need two incomes. You're probably buying not your first home. You're probably buying like that move up home as your first home, because that's what you've been saving up for, and that's all that's available. So it's like 1,200 square feet, maybe even 2,000 square feet. And then, so just the dynamics have shifted a lot. So I'm not surprised that a lot of these, ages have been pushed out due to all of these things. And I do think it's very great for the headlines to say, oh, homes are selling significant discounts, get ready. Well, it depends what you're looking for, because not everything's going to be discounted.
That was a great point about regulation, because 3 years ago, I built a house from scratch. And it was really eye-opening to learn about electrical and plumbing and pervious coverage and every permutation to all the rules. So I can see that a lot more knowledge is required, a lot more effort, a lot more cost goes into the construction of homes from whatever I would have.
Yeah, and we are seeing, some shifts. So depends on the type of policy you're looking at. But for example, single family zoning restrictions have been kind of loosened in some areas. So a great example is Minneapolis. So we're able to build a lot more multifamily. And then with that, rents went down significantly where you could build more. So gone are the days in some of these markets where you have to have a minimum size lot and a minimum amount of parking spots. But that's not the case for the rest of the country. It's just, kind of experimental markets happening right now. Some parts of California as well. But in general, there's all of these restrictions. And if anything, I feel like they're just going to increase because, we're thinking about climate change. We're thinking about disaster proofing. It's not just the coasts that have issues with climate, right? With flooding and what have you, or fires in California. It's the center of the country too, with severe storms and flooding as well. And so there's just constantly more and more pressure on home builders to ensure that houses are just better compared to the pressure on the existing market to ensure that they're kind of renovated or remodeled in a way that's just as efficient as a newly built home. There's a big disconnect there, because it's another thing too. If you do find a house that's for sale for, let's say, $200,000 in one of the more expensive markets, it probably needs a gut rehab, or just, it's just the lot that's being sold and you're tearing it down and you're building new on top of it. Because we have a very significantly aging stock of housing, and it's just going to get older with time.
Yeah, so and those are all great points. One of the other things I was sort of surprised to read was, other than Japan, the U.S. was the only developed market where prices did not fall during the tightening of the economy. Mm-hmm. And one of the suggestions that the article made, and this was from J.P. Morgan, was that there's a prevalence of 30-year fixed rate mortgages in the marketplace, and that's helped sustain the U.S. Housing market.
Yeah, we're very unique. So I was raised in Canada, and in Canada we had a very similar occurrence, like during the pandemic days when interest rates came down to almost zero. So in turn, mortgage rates were low threes, maybe high twos in some times, and so people were really smart about refinancing or entering the housing market for the first time with such low interest rates, mortgage rates. But fast forward 5 years, this is where the disconnect occurred. The U.S. Homeowners could protect themselves for the next 30 years. So if it was a brand new mortgage or a refinance, they have another 25 years to go until they have to let go of that sweet 2.9 or whatever mortgage rate. Whereas in Canada, refinance or fixed only lives for 5 years. So you have to refinance or change the terms after 5 years. So at the same time, the central banks of the U.S. and Canada were also increasing interest rates. In Canada, it was almost instantly flowing into the overall economy because households were preparing to either pay off their house sooner so that they don't have to re-enter into the higher mortgage rate market, or preparing more of that income to go towards higher mortgage payments once the kind of 5-year fixed lapses. In the US, households were like, what interest rates? They did not notice really. So that interest rate mechanism through which the Federal Reserve can impact the real economy is not as strong in the US, specifically through that mortgage market because of that 30-year fixed. And it's very, very unique to us. No other country really does that. Australia has only variable mortgage rates, so their impact on the interest rate mechanism is like instant. So that's the issue. You have to look at other parts of the economy to slow them down if you want to increase interest rates, because the housing mechanism isn't there.
So do you know if there's higher turnover of homes in connection with sales in countries like Canada and Australia because of the duration of the fixed rate?
I would be speculating if I said yes, but we did see the duration of homes last year. This, according to the National Association of Realtors, the duration of someone living in their home has increased to 11 years. So if it hasn't changed in Canada, at least the duration in the US has gone up. And then furthermore, we did see significant change in just consumption behavior related to anything that was interest rate sensitive when the Bank of Canada started raising interest rates compared to the Federal Reserve. And so you kind of get that wealth effect too when people are worried about, how much of their income they can spend on discretionary spending, even though their home prices are still higher than maybe what they bought it for. Whereas in the US, folks are just like, we're feeling wealthy, we're feeling good, and we don't have to worry about the biggest chunk of our debt is usually a mortgage. We don't have to worry about that for another 25 years. So there's definitely a lot of differences between the housing market.
Let's take it from the economist perspective and let's go to your personal life a little bit on this. And I know you're like, what kind of crazy question would you ask, setting me up that way? But as you speak to like your friends, professional, personal, how are you seeing that housing is affecting them? Is it a topic of conversation?
Oh, definitely. Yeah. People are always asking me for kind of like advice. And I tell everybody, including your listeners today, I am not a financial planner. I am not giving any investment or the like advice today. It's more discussing trends, locating risks, and explaining my assumptions about the economy. So with that said, I think in general, I'm also in that cohort that's in their kind of prime home buying years. And personally, I'm a renter. My friends are probably 50-50 in that regard, within the same kind of age group. The ones that bought a house over the last 5 years, some got in right away when the pandemic hit. They, were able to get a condo or the like. Others kind of waited maybe a little too long. But there's, life happens still. So even though mortgage rates are ultra low, that might not be the best time for you to enter the housing market, especially if it's your first home. Maybe you're transitioning jobs. Maybe you're still not sure where you're going to live, right? Because it's a big commitment. So some folks in my friend group kind of enter the housing market a little bit later. And so they have a higher mortgage rate. They were outbid for a lot of homes in the beginning, so they were getting very frustrated. They were very much part of that whole environment where you have to bid on a home without seeing it first. You might have to waive the inspection. Things that are really bad decisions if the house is not in good shape, because then you're potentially going to recognize faults. And thankfully, the ones that didn't have to do inspections ended up being okay. But all of that to say, it reminds me of when we all graduated university back during the financial crisis. And it was a very difficult labor market back then. And there were headlines everywhere saying, because the millennials were the youngest cohort at that point in the labor market. And they're like, millennials are the lazy generation. They only want to rent. They're never going to own a house because they spend too much money on avocado toast. Well, avocado toast was all we could afford because we were underemployed. Even though we were highly educated, we were underemployed for those first few years because there were just not very many good jobs out there. And then we finally caught up with the economy getting better over time. It took a long time to recover from the financial crisis. We finally caught up to kind of real life and are able to make big purchases and start families and all of that. And then all of a sudden COVID hits us, and then the high interest rate environment and inflation hits us, and people are kind of put on their back foot again. And then Gen Z is right behind us, kind of feeling the same thing, feeling like they'll never be homeowners. So they may as well spend money on fun stuff because it's kind of like this like YOLO mentality of, well, I'm not saving for anything. I'll never be able to afford it. So that's
So
kind of like,
more like a defeatist
yeah,
perspective.
definitely.
So when your friends are coming to advice, I mean, I infer from what you just said, despite interest rates, may or may not be the right time for you to buy a home.
Yeah.
But what guidance have you given that you found was really well received that listeners might benefit from?
Yeah, I think it just getting a better understanding of your own financial situation. Because when, again, like we quote home price growth or mortgage rate changes, we're quoting aggregate numbers. If you go to an actual specialist and they can pull up your credit report, whether it's a soft pull or hard pull, they can tell you exactly what kind of interest rates you could be offered. Because if you have really high credit scores, you could get a lower rate than what's quoted in the market, right? You could get better offers. It depends on what down payment you want to do, where you want to buy. If you're looking at condos, think of all the other costs involved, because that's the other thing about the affordability issue right now is that it's not just home prices or rents that have gone up. It's taxes, insurance, HOA, any sort of budget you want to have for repairs or renovations, that's significantly higher. You mentioned your odyssey of building a home, right? So you saw those
odyssey
costs.
Is the right word.
Yeah, I figured.
I survived all the like skeletons with the knives and the swords waiting around the corner for me.
I can only imagine. I just hear it through stories, and it sounds pretty awful. And so if, you have to consider all these other costs. So know your personal situation and consider other costs, because when you're a renter, your rent is probably the most you will pay in a month if you kind of include utilities with that. But if you're buying a house, your mortgage is the minimum you're going to pay in a month. There's all these other costs and calculations you have to fit in. And then also, just think about the general economy. If you're really insecure about your current job perspective, like if you don't have a job yet, it's significantly harder to get into the labor market right now. And then if you do have a job, how good is your industry signaling about strength and in wages and then continued job growth? So just kind of consider the big picture. Don't think like 2022 was the norm. That was not the norm. Like, we're entering a new stage in the economy, and consider all of those factors.
And how has inflation impacted the purchase price of homes as far as you can tell?
So inflation really only shows up on the newly built side, because a newly built home directly from builders is priced according to costs and profits and things like that. So inflation for materials, for labor, higher regulatory burdens and things like that have increased the median price of a newly built home over the last however many years it's been. In the existing market, it's a lot more on like animal spirits, people's sentiment, dynamics of supply and demand, location arbitrage. So like I mentioned, everyone from San Francisco moved to Boise, Idaho, and then some of them realized, wait, no, I don't have a road to my house or something like that. The infrastructure is just not there yet. And then so they moved back. So there's a little bit of that kind of pendulum swing in both directions in some markets. So anything and the stock market follows very similar kind of patterns. You have to understand psychology of buyers and sellers rather than the actual economic
mentality concept.
Exactly.
Yeah.
And you could read a great book, Irrational Exuberance by Robert Shiller. I mean, that book just really nails what happens to home prices, especially in bubbles and in busts, as well as the stock market, because it really is people's behavior rather than the fundamentals.
So I didn't read Robert Schiller's book. Any guidance that he provided with regard to interest rates, mortgage rates, and its impact on the housing market?
It's not something that doesn't impact. It definitely has an impact on people's behavior and the way people are feeling about the economy, but then the future as well. Because if you're making a big purchase like a house, you have to feel pretty good about the future, right? Because this is a continued expense essentially for some time. Sure. So if you're seeing that mortgage rates or interest rates in general are coming down, some people are seeing that as a signal of like, well, back in the inflation days, oh, inflation is behind us. The economy can start kind of moving along. It's okay. But if you only really knew interest rates and inflation from that, 08, 09 to COVID era, you just assume there's no such thing as inflation and interest rates are always low. So now you're in this world where you're like, wait, is the economy bad because interest rates are high? So it also depends on like what you're anchored to. But no, there's definitely causal kind of implications of mortgage rates on the housing market, but it is so much more than that. Specifically, it's a lot to do with jobs and wages. The strength of people's incomes growing is a huge indicator of home price growth, more so than mortgage rates in some ways. And then also that sentiment, that people's forward-looking ability to say, I think the economy is going to be okay. I think I'm going to have a job for the next 20 years and my wages will continue to grow. Now's a good time to enter the housing market. The book is a bit old, but still, there's a lot of helpful tidbits.
I understand the concept still applies what you're suggesting.
So, sure.
So the labor market impacts to some greater degree the housing market.
Oh, yeah. Mm-hmm.
So why don't we shift gears a little and talk about the labor market and what you're seeing. And when you do, if there's any data that you can provide that where you can maybe highlight the 20-something-year-olds, the 30-something-year-olds, 40-something-year-olds, and the 50-something-year-olds. I'm still in the 50s. And what I'm seeing is as people transition from one job to another later in their careers, the ability to hold on to that job seems to come at much higher risk.
Well, yeah, similar to the housing market, where we talk about the labor market, we just give these big aggregate numbers, but there's so much more under the surface to untangle. So I don't think I can give you, verbatim numbers, but I can definitely give you some direction.
And we don't need verbatim numbers. No, I'm not taking any notes. My hand's right here. Hi.
Yeah. So it's been a very difficult job market for new grads of bachelor programs. So anyone that's essentially in, finance, insurance, information, and any kind of professional business services, legal, accounting, what have you, has seen a more difficult time entering the job market. Now, unfortunately, this has happened around the same time that the Fed increased interest rates significantly, so kind of pushing down demand for workers. And the release of generative AI, ChatGPT, was released in December of 2022. So some of these changes in the economy that are going to kind of continue, we're at a bit of a turning point, if you will, with technological change and inflation and all of that. They're all kind of happening at the same time. So it's really hard to say, oh, it's just AI causing this, or it's just interest rates. You cannot parse it out yet. So there's a lot of studies being done right now. Some are being released saying, okay, it's 50% AI or what have you. But I feel like we're going to be figuring this out for a while. We're still figuring out what happened in 08, 09 in some ways. So I think this is going to be a long-term research project. But with that said, it is a difficult time for new grads because they're also applying to probably bigger firms. And we've seen a lot of layoff announcements in recent quarters. Some of that is probably due to AI. But again, we're still kind of coming out of this post-COVID shift where companies really probably overhired. We had huge demand for workers in essentially 2021 and some parts of 2022 because we realized we could work from anywhere, and then companies really went all in on, warehousing and data centers now also picking up, and the shift to AI, shift to automation, shift to different supply chains. Then we got the tariff shock as well last year. So companies are just kind of changing the way that they look at their labor force, whether or not they're going to get the productivity gains that they're hoping for. To be determined. That takes time to see. But I think AI is just kind of used as a blanket statement as to why the layoffs are happening, where there's probably more under the surface. That's just my assumption. I don't know anything directly. But more so, it's that, the entry-level worker probably is going to have to change because you're going to have to enter a company, whereas before, when I first started, I had to learn everything from scratch, take notes, and record everything. Now you can have AI running in the background. You can create prompts, and it creates your chart or a table. You can kind of be an expert, sort of, without as much experience. And so the nature of entry level is probably going to have to change. You're going to have to come in with a lot more knowledge, but where are you going to get that knowledge if you don't get a job, right? So we're still figuring all of that out. We're also figuring out what the pipeline will look like, right? If today's CEO is thinking into the future of, 10 years from now, who's going to succeed me? Where's the pipeline coming from, right? Because now the entry level is kind of frozen up. When we look kind of higher up into more of that prime age worker. So the Bureau of Labor Statistics it calls prime age anybody who's between 25 and 54. That's their definition. So prime age workers traditionally have always had the highest participation in the economy. So those are the years you need to work to, afford things. A lot of prime age workers that came into the labor market over the last few years actually were international. We had a huge influx of migration. Over the last few years, documented and undocumented both were being calculated, and that really helped absorb some of that demand, especially for things like leisure hospitality, like restaurants, hotels, anything in the care economy, anything in healthcare, agriculture, construction. It really helped with the net immigration. So there's a big participation, but there's a lot of demand for those workers. Those workers are probably still okay in general right now because, like I said, it's the entry level that companies are kind of pulling back from hiring. Some of the prime age are probably being included in those mass layoffs, but we're just not seeing that in the data quite yet. The layoff rate, it hasn't really budged up too much, but we are a little bit delayed in the data because of the government shutdown last year. And then the oldest workers, so the 55 plus that are considered outside of prime age, they have really slowed down their participation in the labor market, and they're not expected to come back. And as our kind of population pyramid continues to invert, so we are going to have way more workers or way more folks in the economy who are 55 plus, especially 65 plus. They're not participating, but they're using up resources. So we're going to need kind of the workers to help support those folks.
So slow down. So when you say they're not participating, but they're consuming resources, can you slow that down and explain what that means?
Yeah. So a participating worker is defined as someone who is either employed, full-time, part-time, whatever, or is unemployed but has looked for a job in the last 4 weeks of every time that survey is conducted. So you are not considered participating in the economy if you're retired, if you are on any sort of leave of absence, whether parental leave or anything else, if you are in school, or if you are a child, you are not yet of working age. So those are just some categories of folks that are not participating in the economy. So a larger and larger share is going to come from the retired generation because we're just going to have more and more of them, and they're not participating because they've retired. If a retiree decides to come back to work or part-time, then they're considered part of the labor market. We actually saw a big return to work by a retired cohort back in the financial crisis because people lost their nest eggs. That's not a good reason to come back into labor force. It was a necessity for many because they just had nothing else to live off of, and medical bills and all of that were accumulating. So barring any sort of financial crisis or anything in the future, we don't expect the 55 plus cohort to return to the labor market in big numbers. Like they did back in kind of 08, 09. So that just puts a lot of strain on that prime age cohort that's going to have to continue to not just work, but take care of parents and or children, right? So there's going to be kind of non-paid work expectations. And that's a very tricky position to be in because ask anyone who's kind of sandwiched between aging parents and young children, or young siblings, it's very difficult to fully participate in the labor market if you have all of these challenges. And that is why we saw a huge jump in female labor force participation when we first started doing working from home, because it was a lot more manageable when you have other duties to be able to participate in the labor market and work from home, or work in a flexible hour kind of arrangement where you may be, doing Instacart shopping or something. You can set your own hours, so you can pick your kids up from school or what you need to do. And we've seen a small decline in female labor force participation since then, but it still remained elevated compared to pre kind of hybrid work environment levels. And so I'm kind of optimistic that this, rush back to the office 5 days a week is not going to be for everybody, because you might lose some workers from that if people can't come in 5 days a week. So that was kind of like a holistic summary, but we can dive into some of the details too.
A few questions. One is, I guess, out of curiosity from my perspective, is there any data to indicate that people are working longer and retiring at later stages of life?
I think the most recent data I saw was that people were actually retiring earlier. We had a big wave of early retirements in the last few years. Some of that really does have to do with that accumulated stock market wealth. People
Yeah,
feel
that's what
good.
I was thinking as you said
Yeah.
that.
Yeah. And then housing market wealth too, because we also have an economy where majority of homeowners are older and majority of the wealth in housing is concentrated to the oldest cohorts, especially baby boomers and some Gen X. And so if you feel good about the future of those assets and you don't think you need that income stream anymore and you just want to spend time with your grandkids or golfing or whatever, traveling, you're going to say, why retire in 2 years if I can just do it now?
Yeah, I'm curious. I don't really have that many friends that are doing that, but it makes me wonder. And that's sort of not my game plan.
Sure. Yeah. Yeah. I
And
mean,
then
not mine either.
are we seeing what's going on in the 20 something rankings? Any data there? Is it still really hard for them to get their first time job, or are most of
Yes.
them underemployed? What's the data you're seeing?
Um, I don't have the underemployed data, but they do have an elevated unemployment rate compared to history. So that is still going to take, I think, some time, especially as we're still getting layoff announcements by a lot of larger firms. It's kind of the environment's not great. Also, the hiring process has really changed. It's not just applying online, but there's also now AI filters you have to get through. So I feel like it just takes longer to get your resume through or to have somebody see it because recruiters and hiring managers are also getting resumes of people that are not serious too. So they're trying to sort through and get people that are legitimate, and there's kind of the matching, I think, in the labor market could probably be a little bit better. And in general too, there's still, now that some companies are back in the office, there's still some locational differences, skill level differences that are just not being matched. And it's always the case, and this happened to me when I graduated. I graduated with a finance degree into a financial crisis. So I did not see a financial crisis coming the 5 years prior to that when I first signed up for a finance undergrad. And so that happens too, right? Like folks are graduating now with degrees that it could potentially, at least the entry level version of it, can be replaced with AI, like paralegals or what have you. And so it's hard to help the youngest folks kind of think about the future. Right now, what do we need right now? We need folks that can mine rare earths, construction workers. We need, anything to do with like defense or semiconductors, technology, engineering, plumbers, electricians, all of those skills. I just don't think I think the jobs are available there. We just don't have the entry level folks entering those markets, and everyone's kind of concentrated in like financial services, accounting, legal, consulting, and it's just those companies are not necessarily hiring right now. So there's a bit of a
Think though that,
mismatch.
but I would, sorry to interrupt, but I think that would
Yeah.
sort of lend itself to the drivers of education in the United States.
Mhm.
And my generation, some people whose parents didn't go to college, where college is a presumption now for many people, you are going to college.
Yeah.
And as the workforce became more educated, there were people less willing to go and do the more manual labor job that they perceived to be not as economically rewarding, socially rewarding, a range of different biases that existed. How does that, any sense of how the United States compares to other countries as it relates to our jobs versus the jobs in lesser developed nations?
Yeah. That one's hard. The only good example I have to compare and contrast is with the country of Germany, because they're so vocal about this kind of system that they have in place where essentially you can finish high school and then finish it all the way to, I don't know if it's like 12th or 13th grade, and then kind of continue to college or university. Or you can kind of finish at the minimum, which is I think like 10th or 11th grade, and then go into a trade school. And it's a really great pipeline because early on, the kids are exposed to what kind of jobs they could have and, based on their skills and interests. And then, they can go and trade school. And then the degree or the careers that come out of it are highly regarded. A manufacturing hub like Germany, people are proud to work for some, those companies. And so we just, like you said, exactly right. Like culturally, we've started to kind of look down at some of those like blue collar workers and the jobs that they have to do. And we kind of didn't realize that there's going to be so much more demand for those workers that they're going to be commanding six figures at the start, especially if you own your own company, right? And the issue, though, with anything to do with, like manufacturing, what have you, there's also a lot of technological change that's been happening in the background. So it's not that we need the same amount of workers that we had back in the 50s, because these factories and a lot of these jobs come with technological solutions that you might need only one or two people for instead of a whole group to work on. So it's not like, we're going to have this manufacturing construction renaissance in the US, but we are definitely short on workers in those fields. So I hope folks start to see that and recommend that to their kids, or the next generation starts to see it, and maybe Gen Alpha, Gen Beta can start going into those fields.
Yeah, it's look, as a parent, and I know that you haven't had the experience yet of being a parent. I know that when my children came to me for guidance, or have come to me for guidance, there's a lot of apprehension of giving them bad guidance, meaning I'm willing to take the risk for me and suffer the consequence. How horrible would it be if my child suffers a consequence because they relied upon advice I'd given them?
Yeah.
So finding the right career path isn't a straight line. It's for most people, it's not a straight.
Yeah, not at all. And that's constantly what I tell students, especially students of economics. Economics is having its own kind of slowdown in hiring, especially PhD level. I'm a business economist. I ended my education with a master's degree, but I did get a certification in a certified business economist so that I could kind of stand out in a crowd. But I got employed prior to the pandemic, but it's definitely not a linear path at all. And it like I said, the hiring process now, you get so lost in the all of the job posting and everything online, and all of these you have to search for certain words in your resume to make sure they match the words in the application. It's very, very difficult versus talking to people and using your network and getting to know others and talking to people in the jobs that you want to have to see if that's actually what you want your day-to-day to look like. And there's just so much more advice than just study this, then get a job there that I can offer, because it's very, my own life has career path has been very nonlinear. And I think that's just going to continue to be the case in an economy that's structurally changing due to technology and all of these shifts.
No, and I get that. Listen, I founded Sadis with some other people when I was 30 years old.
Wow.
And that was, I'm turning 60 this June. And I think before then, I really wasn't sure what the right path was for me. I enjoy practicing law. Had a great experience working at the SEC. After that, different businesses have different ethos, and also the time in history. There's a lot of variables. And then the question is, do you work to live or live to work?
Of course, yes.
Which, as far as I can tell, my advice is there's no real balance in one's life. You're either biased towards your home life or you're biased towards your work life. And every time you try and really play it 50-50, both suffer.
Exactly, yeah. You take turns focusing on one or the other.
Yeah, the pendulum will swing.
Yeah, agreed.
So all right, imagine you're giving guidance to my son and his wife, and they're frustrated. They were in attorney review. Somebody came in and offered a higher offer to the seller, and my son and his wife did not top up their offer, and they lost the home. It happens. I've been there too.
Yeah.
And I've actually been the one to sweep in and offer more money during the last day of attorney review, where the other purchaser did not up it. And that's one of the homes I live in right now. So I've been on the receiving and on the giving end of it. But what advice might you give, either with your economist education or your day-to-day of life experience? What advice might you give people, especially first-time homeowners?
Yeah, I think definitely very clearly assess your goals and kind of what's necessary and what can wait. And that's more my personal experience head on, because especially depending on what market they're looking in, it could just be still at a peak. And if someone's coming in with a higher offer than them, there's clearly still demand for the price point that they're looking at. That could be short-lived, or that could be the new normal. So it's just a matter of time of saving more or adjusting your expectations. Because, it is, like I said, it's the psychology of it. Sellers have had these really unrealistic expectations of what their homes are worth over the last few years. But buyers have also kind of had unrealistic expectations of what they can afford, because the economy just shifted so quickly under everyone's feet, especially with inflation and then interest rates. So I guess really just boiling down to understand what it is you're signing up for. Is it worth it to stretch yourself whatever few $100s a month, or is it worth it to only have one bathroom? I don't know. Just be really honest with yourself, and then also be really honest with the fact that, okay, if we were to be doing this in a recessionary environment, what would we do differently? Like scenario analyze. That's what I do for all of our forecasts. The whole team will do scenarios every month, because we need to understand, okay, but what if this changes quickly? We have to respond quickly. So what would you do in a recessionary environment if you had one of you lost a job, God forbid? What would you do in an environment where rates are super low and cash is flowing, the Fed is printing money? What do you do then? What do you do if the stock market crashes, right?
So you mentioned an interesting point. I just want to slow it down on. So
Yeah.
you mentioned, based on my, not using your exact words, peaks and troughs of a geographic area.
Yeah.
So if somebody's trying to assess, look, am I trying to catch a falling knife and prices are just going to keep going lower, and we're not even there, or am I at the top of the market? And how would you advise them to assess that?
Definitely talk to experts in your region. So, whether it's the realtors, a small business association, just people living in the area. There's, obviously as individuals, we don't have access to great research that some of these big houses have, but, S&P, Moody's, Oxford, they all do local analysis, regional analysis, and forecasts. So you can kind of try and find something online and say, is this city growing? Is this city in a recession? What's to come? What are some big company announcements that are going to set up shop there? Or what are big company announcements that are moving out of there, right? Because a lot of those economic changes then dictate home prices. So if you have
and by the way, so the place we bought a home, me personally, is 15 minutes away from where Netflix is building $1 billion campus. Now, we were trying to assess, is it baked into the price or not? Now, the reality is inventory is horrible. So when we were looking, and even now, there were very few houses and everything lists as pending. And when you went to an open house, everything was being sold at a higher price than ask.
Yeah.
And it's not clear if that's going to change. So I was trying to do the analysis, but realizing to some greater degree, it's also the flip of a coin.
It feels like it, because some of the models that we traditionally use, like I'm trying to create a home price model that I can adapt as more data comes out, and it's very difficult because some of these older theoretical models don't work on what drives things. And I think there's still something to be said about local incomes, local job opportunities that will help drive the housing market, but some of it still really is that arbitrage opportunity. Some people are buying their second home, or they're buying homes to rent out. And I'm not talking about institutional investors. I'm talking about majority of investors in housing in this country own fewer than 10 properties. So they might be looking to Airbnb it if they think it's a new community that will be sought out for tourism, for example, in the Carolinas or what have you. There's a lot of investment dollars going there. And then also note that a lot of people, so yes, the first-time home buyer, median age is 40, but the repeat home buyer right now, median age is 62, also a record high. 62-year-old households tend to have more wealth, more equity. They can actually buy things in cash. And so if you're using a mortgage, you're completely out of the competition, because you're going to have these all cash buyers coming, really offering whatever they can.
So you're saying that the 62 is the age where people are purchasing and selling more than one home at any given time? Is that?
It's just it's not their first home that they've purchased or sold. Yeah. So 62 is the median age of just general housing market activity. And a lot of that does get supported by the all cash purchases, because they have the equity. They can take out a home equity line of credit and then use that for a down payment. They can just sell their house and then buy a new house with all cash. And so it's a very different competition as a first-time buyer, because you just need more and more and more of that down payment.
Before we wrap up, anything that you might want to highlight, whether it's on the housing market or the labor market, but if you want to go into inflation, student loans, or any other thing that you think is really worthwhile for the listeners to hear?
Yeah, I think just in general, it's conditions have been very tough for a lot of households in the US, even as economists say, we had another great year, GDP was stronger than expected, or the unemployment rate is lower than we thought it would be. That's all great on paper, but people are not necessarily feeling great because a lot of costs that they've seen go up are not keeping up with the wage growth that they've seen. Even if people are still employed, they're not necessarily feeling good about their job prospects or their kids' job prospects. And so you kind of get this disconnect between actual activity in the economy, where we get data on what people are spending on, retail sales, going out to restaurants and buying cars, versus the sentiment surveys that are signaling, recession to come because people are feeling so bad. And if you're feeling bad, you're not going to spend. If you're not going to spend, then it's a recession. So traditional ways of looking at the economy and like trying to get a gauge of what's ahead are not that great anymore, and things are a little foggy right now. So definitely just try to pay attention to things like, what is the Federal Reserve saying? How do they feel about interest rates? What are people actually spending their money on? Is it big ticket items, or is it more just the avocado toast example, or that lipstick index where people buy lipstick in a recession because that's the only thing that they can afford.
They want to buy something.
They want to buy something. Yeah. And just get an idea of like the actual activity that we're seeing rather than, surveys. Because I feel like it's just harder right now to get sentiment and use that as a useful indicator for future activity. And then on the student loan thing, just very quickly, simply because this has been an issue for a while now. So student loans were kind of put on furlough, if you will, so you don't have to pay student loans down during the pandemic years. And then that all ended in 2024. And then in 2025, we started getting reports of actual delinquencies and defaults for student loans. So we've got something like, I think it's 5 million defaults and 3 million delinquencies, or flip those numbers around for student loans. And the median age, according to the New York Fed, the median age of a borrower that has a student loan in delinquency right now is 40 years old. So perfectly overlapping that first-time homebuyer. So that's another pressure point for that prime age population that is working, trying to buy a house, trying to maybe start a family or create a life for themselves. And then now they potentially have an erosion in their credit scores, inability to access any other kinds of loans to make big decisions. And so there's just things happening under the surface that are not necessarily talked about as much, that I would like to talk more about, because I feel like that also helps dictate how people are feeling and the financial decisions they're making. And all of those things just take time to work their way through the economy. If the Federal Reserve cuts rates 300 basis points tomorrow, it's not going to be like, everybody's fine now. It takes time for these conditions to work their way through the economy. People still have jobs. People are still seeing income growth. And so that's helping support some of that. And that's why we're not seeing personal bankruptcies go up just yet. But if we were to have interest rate hikes, higher than expected inflation, even more layoffs, then I think the shoe will drop and we could have a potential recession in the cards. So a lot of uncertainty. We're dealing with.
I feel that. I mean, I've been feeling it for about 2 or 3 years, where I'm waiting for the other shoe to drop. It hasn't. I got a little bit of bated breath. Things have gone better than I would have expected, but it's still not all adding up to me. And I don't know how many other people have that. I worry whether it's because of where I am in the stage of life I'm in, and the people I socialize with. But my friend group is really. It's like a 30 to 40 year age spread. And there's a consistent sense of, from what I can tell, anxiety in the world with what's going on politically in the United States, what's going on with our immigration policy, what's going on globally with Iran and the Ukraine and Gaza, just to mention a few hotspots. And now you add in like the last 2-3 weeks, this cold weather in the Northeast. I don't recall it being this cold for this long, and it is grating on people. Yeah, people don't want to go out. Yeah, I was at Off Saks yesterday looking for something, and they said they were supposed to have a liquidation event, and the liquidators, due to the weather, were still stuck in the South and not coming up north. So it even while that could be an isolated situation, what's going on with the weather in the Northeast is definitely affecting the economy on some level.
Oh, definitely. Yep.
So I'm really curious how all of this will play out. And the way I look at it is, if interest rates go down, because I'm paying for one of my homes 2 7/8 on a 30-year. So I'm loath to sell it because I may not see that rate for many, many years, if ever.
Yeah.
But if the rates go down, we might see a little bit of a spark again. Not that it should or shouldn't be done. But
Well,
anyway, yeah, sorry.
no, just the point that you made, and kind of, I encourage you listeners to remember that, like, what's happening right now with the cold weather and the high uncertainty, and even, prior to the holidays, we had some cold weather blasts, especially in Chicago. That shows up in the data that we look at and analysts look at with a lag. So once we do finally get first quarter data, we could see significantly slower consumer spending, significantly slower, supply chain movements or what have you. And I worry that sometimes headlines miss the mark on what actually happened. So we always have to remind ourselves, well, what did happen in the first quarter? So there is this kind of, we're always forward looking, but we also have to remember our past and where we come from to make sure we have a good understanding of the economy. Because if you're just going to say, oh, economy slowed down the first quarter, recession ahead, we have to start cutting interest rates now. Well, just wait. We had bad weather, right? But policymakers know that. It's more just, I warn people to always read headlines cautiously and look for the sources elsewhere as well, just to get a better sense of picture of what they're reporting on. But yeah, we could have some slower activity reported ahead.
Well, Yelena, I really appreciate your time today, and
Thank you,
you're shedding light on some very opaque subjects and making it far more interesting than it would be in most other situations. And I hope to have you back.
Yes.
And you did a great job. And I'm sure a lot of the listeners might have picked up several points of fact that might help them.
Well, it's a pleasure speaking with you. Thank you so much for having me. I look forward to hopefully coming back, and I could talk about this for hours. So